The fund rose in value by 30 percentage points over 2013, which was a good performance in an absolute level, but it did lag the benchmark for the fund, that was up 37 percentage points. Almost all the difference, though, was accounted for by two write-downs of our remaining two unquoted holdings. But I'm very happy to say that Hurricane Energy, which is the last of our unquoteds, has confirmed that it will be IPOing on the AIM market in February in 2014. So that puts behind us the huge drag effect to the performance of the fund by these unquoted, which has been, over the last 5 years, amounted to 48 percentage points. So it's been quite a material drag on the fund. But I'm happy to say that that's now over with, so that going forward, there will be no more investments in unquoteds, and that drag factor will not be there. The investment process that the fund follows is a very set one, and it really does rely on investing in high-quality business franchises of companies. So we like to see high returns on capital, a good track record for earnings, and very importantly, that the profits that companies report to their holders is converted into cash flow strongly. Now, with a process like that, it does tend to underperform when there's a rampant bull market where lesser quality, or I would argue that lesser quality shares tend to do better. It tends to do well when markets are normal, but it tends to outperform best when markets are tough. I've been very happy with the underlying positioning of the fund over the year and now. While there has been one or two disappointments, such as H&T, the pawnbroker, which has been hit by a weakening gold price, there has been some real winners. So Somero, the laser-guided concrete levelling company, that those shares trebled in value in the year. But of the bigger holdings, so Mears Group, Brooks Macdonald, CVS, for example, GB Group, they've all done very well in terms of their underlying trading, and I'm very pleased with that. I think it's probably quite interesting to note that of the biggest sales of the fund, all of the four biggest sales were of mid-cap companies, and I have found that the mid-cap index, because it has risen so strongly, is leaving quite a few of the old faithful mid-caps rather expensively valued now. And this is a bit of a sweeping generalisation, but I see better value in some of the micro-cap stocks. So we have been investing a little bit more in that area of the market. Conscious that when you're doing that, the liquidity issues involved are much more pronounced. So it's a balancing act. And at the moment, there's about 20% of the fund that's invested in companies whose market cap is less than £100 million, but that's balanced against about 30% of the fund, which is invested in companies which are over 500 million market cap. And I think we've got that balance about right. There's no doubt that the small cap sector has been the best asset class to own if you're an investor over the last 1, 3 and 5 years. They've had a very, very strong return to investors. Most commentators are still very bullish about the prospects for UK small caps, and they point out that although valuations of small caps are no longer the bargain basement that we saw at the end of 2008, they're not that high by historic standards, and they're only on a small premium to large caps for a faster level of growth. However, I would be a little bit more wary than that. Investors generally make the best returns when everyone is gloomy, not when they're positive. Having said that, the potential for M&A activity is still huge in my opinion. And I know I've said this last year and it didn't really happen in 2013, albeit we did get Andor Technology, a small holding of ours, taken over by Oxford Instruments in the year. M&A still has the potential to act as a backstop to valuations, even at the current price. The fund at the moment is on about a 6.5% free cash flow yield for 2014. When you compare that with what companies can borrow, the cost of debt is sub 4%. There's an arbitrage gap there that can be attacked, if you like, from large companies possibly buying their small company competitors, and I think that's very encouraging for meaning that the current levels of small cap, the small cap market is not overblown. So although I wouldn't go extrapolating 30% returns into the future by any means, I'm still cautiously optimistic about the future for small cap.